I think it was about 12 years ago, sometime 12, 15 years ago, went in front of Mr. Warren Buffett and Mr. Charlie Munger
You
and
gotta
asked
stop.
the
I know
question.
that's a joke. You can't say buffet. It makes you sound like dummy head.
This podcast contains the arguably witty banter of two friends, Skippy and Dougals, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Something really bad happened this week, Dougals.
Whew.
There were some votes cast in favor of your opinions from last week, which
Boom,
makes me very frustrated.
boom. And
The
then it went
good
the opposite
news-
direction.
The good news is that we're tied.
This cannot stand.
Oh, it absolutely can. Well, yeah, no, it can't because I'm going to win.
This cannot stand. Okay. Even if you've done so before, hit the trail again. Is that what it's called when you go in to vote? The booth. Hit the booth again.
Yeah.
SkippyDougals@gmail.com. Let us know whether you believe, let's abstract it out. It's just Dougals versus Skippy. This is getting personal.
No. It's all about Winnie the Pooh, Blood and Honey. If you have no clue what we're talking about right now, you have to listen to the last episode. It's about Dougal's poor take that some copyright law should go to countries or something or last longer than 95 years because he's fired up about Winnie the Pooh.
SkippyDougals@gmail.com. Should there be some kind of quote unquote iconic copyrights that the government is able to save and not have go into the public hands? Or no, should we continue being lame?
I think that's hogwash, but I am tempted, just probably maybe somewhere along the Colorado, Denver metro area, to get a group of listeners together and hit up this Winnie the Pooh, Blood and Honey movie as a show event, because I think I need to see this movie with you now, Dougals. I think that's just what has to happen.
Yes. And then there will be like an over under on whether or not we can make it through the whole thing.
Oh, I'm staying. I'm going to love every second of that.
All right. What do you want to start off today? Fish bowl it.
I want to throw some shade. Better yet, I want to talk about people throwing shade. And it's one of those, I'm like in this 100-degree no shade zone in the Mojave Desert. And I really liked sliding under the shade tree. You follow that?
No.
All right,
But I love
here we
it.
go. Dougals, how do you lose $1 million?
Like blank check style, like that kid that got hit on his bike back in the 90s.
No, listen. So two investors saved $10,000 annually for 40 years, and both invested in the U.S. stock market, which returned an average of 8% per year. This math, I haven't double checked it. It's from @honestmath on Twitter. We'll hope that his handle is true. Investor A buys passive index funds through Vanguard with an annual expense of 0.08%. They end up with $2.5 million. Investor B still invests $10,000 a year. It's a great return. For 40 years, buys the exact same funds. They invest with Edward Jones. Edward Jones charges a 2% annual fee with expenses. And I think some of their funds even have a front load, which is like something from the 80s. It's so bad. Dun, dun, dun. They end up with $1.5 million.
Oh my goodness. Man, this makes me think about Coolio.
Why does it make you think about Coolio?
Me and Edward Jones got a thing going on. Wouldn't call it love, but his show is strong. That is,
right.
I love this depiction. It's so clear.
And listen, I don't know why I love throwing shade at Edward Jones. It's not really about Edward Jones. I'm sure there's some fine people that work there, but a 2% expense fee annually is insane. We're talking 20 plus times Vanguard. And it truly eats. We haven't talked about this on the pod in maybe a year and a half. And it's something that's always important to keep in the back of your mind. Now, the difference between a 0.08% fee and a 0.15 or a 0.25, not nearly as huge. I can fully understand why some ETFs or mutual funds are more expensive. It makes sense. That's a different debate. But make sure none of your investments are falling in a bucket where the expense ratios are over gosh, even 0.5% probably, and you're going to make yourself $1 million.
Well, hold on. You,
Too strong? I was going for a simple conclusion to wrap up my thought there.
I know, and you had it. It was just like when my former boss was crushing this client pitch, right? We were like, we got the deal, money's in the bank, right? I'm starting to do my Dougal's jig. And then she closes it out by saying, it's just like the old saying goes, you can take a horse to water, but you can't teach it how to fish. It's like,
that did not happen.
That did happen. That did happen. So here's where it went awry. There was a promise of $1 million at the thing that you were just talking about. But
yeah, all right.
Yeah, I think the raw point, like, is that we've discussed hidden fees so many times on the show. This is not a hidden fee, but people, I think, hide it from themselves. It's a very transparent fee. You know you're paying 2%, or you know you're paying 0.08%. I think where we hide it from ourselves is we don't look at the averages and the percent that percent is of the average.
No, I disagree. A lot of people that don't know squat about investing know they've seen some Edward Jones commercials, and there's competitors. So I'm talking about Edward Jones, but there's other ones that are just as bad. And they say, I don't know what I'm doing. I'm going to go talk to this person. They get the fancy printouts that are gloss covered. They talk to the receptionist at the front of the office. All that stuff costs money, people. They go to these offices are spread out every 5 miles across most of the US. Like, all that stuff costs money. And they get this peace of mind, which is great. That's what Edward Jones is selling, that they're going to do things the right way. When it turns to something that's not so great is when the advice they get is pretty common sense, personal finance advice. And then they take a 2% annual fee to do that. That's incredibly expensive.
Okay, I can buy it. Okay. And it reminds me of something in my fishbowl.
Let's go.
A very famous individual in the world of podcasting today, I think it's about 12 years ago, sometime 12, 15 years ago, went in front of Mr. Warren Buffett and Mr. Charlie Munger.
You gotta stop. I know that's a joke. You can't say buffet. It makes you sound like dummy head. Using my 9-year-old's vocabulary.
It makes you sound like a dummy head. Okay, Warren Buffett and Charlie Munger. So at their annual meetings, the Berkshire Hathaway annual meetings, they always have a Q&A. People can come up, ask questions, right? Not anybody, right? But they select questions people to ask. I'm going to play maybe like the first 30 seconds, let's say, of this clip, and then we'll summarize a bunch of the other parts of it, which get to the heart of what you were talking about here. But I just really enjoy how, and by the way, this is Tim Ferriss, is the famous podcaster I was talking about. Here's what I love about this. We'll get to the investing part, but what I like about this is today, Tim Ferriss interviews all these people, right? World famous folks, and is charismatic, is
he
confident, is self-assured. I'm gonna play this. Here's some stuff.
Let's go to number 6.
Hi, my name is Timothy Ferriss. I am a guest lecturer at Princeton University twice a year. And I'd like to touch on an earlier question about investing with small sums of money. I'd like to ask both of you, if you were 30 years old again and had your first $1 million in the bank, how would you invest it, assuming you're not a full-time investor, you have another full-time job, you can cover your expenses with other savings for about 18 months, no dependents, and it'd be really helpful for my students, for myself and others here, if you could be as specific as possible about asset classes, percentages, whatever you're willing to offer.
Well, I'll be very simple.
Can
How
I guess
cute is
Buffett's
that?
answer?
How
It's
cute is
pretty
that?
Cute. It's pretty cute. Okay, what part of there's so many layers of the onion to break down. Where do you want to start?
Well, I want to make sure that we do summarize Buffett's answer, but you just want to talk about the question? You want to break apart the question first?
It's classic Tim Ferriss, even though it's before he's famous.
This is classic. This is classic Timothy.
Damn it. Okay, so it's actually the thing I love about this Diggles is it reminds you that people come from somewhere in like a very obvious way.
Exactly.
He said guest lecturer at Princeton twice a year, probably because that's the coolest title he had at the time. I mean, that's amazing. Like you said, now he's, I don't know how many millions he's worth or how popular he is, but like he's a big deal. And that was the best thing he had going for him 13 years ago.
Yeah, I mean his like sub caption, you know, when they have the caption when people are like in a documentary and they say what you are.
Yeah.
His sub caption now is multiple best-selling New York Times author, #1 podcasts in America, angel investor, early investor, and ... Like he has got all this stuff like that happens now. And then he was like a couple times a year, I break into a lecture hall at Princeton, yell some things, and leave.
So I'm gonna have to contact him and tell him that his headline should be someone who doesn't follow Buffett's advice, because clearly Buffett did not tell him to go write some books, invest in early stage companies. I mean, come on, man. How
Yeah,
disrespectful is this?
It's very true. It's very true. Okay, to summarize the question, what Tim Ferriss is saying is he said, if you are an investor who's not a professional investor, you have $1 million in the bank, you're young and don't have responsibilities, not married, no kids, how would you invest your money? That is the question. And then what, to your point, he got real Tim Ferriss about it and went, I want specifics. Like, tell me.
It would be
tell me
helpful for me and my students because I'm a guest
Exactly.
lecturer.
Yeah, exactly. He's like, tell me what brokerage to use, who at that brokerage, what their email address is, where they went to college. Like because Tim Ferriss loves to get into detail. But he's saying, what are the asset classes? What percentage breakdown would you have?
So
cetera.
can I guess at Buffett's answer? I honestly haven't listened to Buffett's answer. I just listened to the Tim Ferriss part. I bet he said index funds with 10% bonds. Is that what he said?
You're very close. You're very close. No bonds.
He said 100% index funds?
Yes. He said,
Ooh.
yeah. He said, you are a self-proclaimed amateur investor. And so I would put it all in a low-cost mutual fund, probably with Vanguard. That was Buffett's answer.
You said this is 2010? What year is this exactly?
This was 2008. So
okay. Then I understand why he said yeah, because the S&P 500 is a deal at that point. So that makes sense.
Now, where it ties back to what you were talking about before, which is a fantastic point, is Buffett also said, no one else will give you that advice because they aren't paid to give you that advice.
Yeah.
Mic drop skippity doodah.
Well,
I loved it.
Sorry, I can't get off the Edward Jones point. Edward Jones is giving you that advice. They're just charging a ridiculous sum of money so you can stop by the office once a year.
Mm-hmm.
And so they can like write down notes to remember your kids' names.
which Tim Ferriss wants to know. Tim Ferriss wants to know the kids'
Tim
names.
Ferriss is like,
the other part of this.
Tim Ferriss is like, he wants a robot that sends him a quarterly email summarizing market performance and remembers his kids' names.
Exactly.
But to buy Vanguard funds. I love it.
The other part of this I really liked is what Buffett says. This sounds like it's condescending, and it might be, but I think it has a purpose for it, because Buffett will often use synonyms, I'll say, for amateur investors, say something like a know-nothing investor, right? Which might sound like a condescending term. The purpose of it, I think a strong purpose, whether or not Buffett means this, I don't know, but a strong purpose of it that it serves is to emphasize how knowledgeable Buffett and Charlie Munger believe that you should be if you take the route of investing in individual stocks. That's their belief structure. I also think that you should be pretty knowledgeable, but that's why they use this. But here's what Buffett says. You'll get a perfectly decent return doing what I said over a 30 to 40 year period. And why would you expect anything more than that when you don't bring anything to the party?
It's pretty condescending. I don't think he meant it that way, but no, this is the the real challenge when it comes to investing. Like, hardly anyone wants to spend the time to do the actual research to understand the human psychology that is at play and everything else. And then everyone wants above average return. And what he's saying there, he's similar to Munger, who we talked about last week, in terms of he's just not going to beat around the bush anymore. He's answered this same question thousands of times. And that's the right approach. Yeah, I totally
Agreed.
am on board.
Agreed. I buy it. I loved it. Love the clip. Love everything about it. Love the beginning nervousness. Love the answer. Fishbowl me.
This podcast, although I read the transcript, is called "The 5 People Keeping Bitcoin Alive." And I almost fell off my chair reading this. Okay. Bitcoin's current market capitalization is somewhere around 500 billion. Douglas, walk me through the Bitcoin talking points.
Which talking points? Like the
Pretty
sell?
much one: decentralized, future of finance, digital.
The world's coming to an
gold.
end. If the world comes to an end and everything's burning down, don't trust the government. Own Bitcoin.
If you go back to the creation, and listen, I'm nowhere near an expert, right?
The Great
In
Creation.
2011, coming out of the no, of Bitcoin. In
Okay.
2011, coming out of the global financial crisis, we're going to create this new type of money. Satoshi writes this brilliant paper. Like, this is now almost a fairy tale in terms of how brilliant it was and how it's decentralized across all these computers. And hey, I believe a lot of this. I still hold a little Bitcoin because I think there's a potential for an asymmetric outcome, but like, the party's kind of stopped, right? Well, if you believe this breakdown by a Wall Street Journal author named Paul Kirian, names are not my strong suit. There are really 5 people that work on the so-called Bitcoin core that upgrade the technology to fit into new apps and new systems. And of course, the technological world in 2023 is much different than the technological world in 2011. So it makes sense, just from like people like us that know about business and software, that there needs to be some people behind the scenes maintaining this thing, right? And according to him, and he's done a deep dive and written articles about it, there are 5 people that do this. They get paid in grants, typically between $100,000 and $150,000 a year, which is interesting because a Google engineer can make $200 to $300, right? So it's not like they're paid incredibly well. There's no formal interview process. There's high turnover with this group. I'll pause for a second, but the real, like, sit down and take a deep breath moment that comes out of, if this is true, is you have a call it a $500 billion company. Call it that 5 people maintain basically the code for, and everything that happens is dependent on those 5 individuals. How not decentralized is that? And how fragile is that?
This to me just continues to fuel the whole fire. That you brought up the fact that the creation story of Bitcoin is at this point a fairy tale.
Yeah.
The whole thing feels like a freaking fairy tale to me, to be honest. I mean, and it's just, again, it feels to me like, I was jokingly said this before, but I do actually think a version of this is the thing that like makes my brain explode, is that Bitcoin to me makes perfect sense if your bet is on the global financial system burning down, and simultaneously somehow servers are still running. Someone is still like making sure they happen. It's such a weird thing that, like, now it just feels even more powerful, because you have to say that all breaks down, but these 5 people are still like, cool, I'll keep doing it. Like, like the rest of the world's falling apart, but you have 5
for
people,
my
like,
below average salary. And basically, it seems like there's even some names in here. It seems like they all do it because they like Bitcoin, which is cool. let me give you one more example again, I haven't independently validated these facts. I
Yep.
just trust in here. Apparently, in September of 2008, someone reported a crash in Bitcoin Core where developers noticed that you could create coins out of thin air or potentially spend the same coin multiple times. What is the entire talking point for Bitcoin Dougals? It's fixed supply, right? That's where the value comes from. In September 2008, there's a bug that these 5 developers had to go in and fix that allowed people to either create Bitcoin out of thin air or spend the same coin multiple times. That doesn't, if that's true, that doesn't mean that Satoshi actually cracked the code at all in 2011, because there's clearly bugs that enter the system that allow his core principles to be overwritten, right?
Well, I mean, the whole thing, I shouldn't say that. That was way too aggressive, and I don't know nearly enough about this. So let me say this. It seems to me, as an outside-in person, that the brilliance of all this is blockchain. And Bitcoin is a use case example of blockchain. That to me is like the way to read this. And so like Satoshi wrote a paper about blockchain and Bitcoin as a currency that could run on blockchain. The currency is the thing that gets like all of the I'd say mass media attention, not all the attention, because blockchain gets a lot of attention for other reasons, but like the mass media attention generally goes to Bitcoin. But to your point, I mean, the currency wasn't foolproof. I'm not saying blockchain was, but to me, I think blockchain was like at least what that stuck with me. It was the big thing that stuck with me. That's my whole thing.
We've had this debate before. That my take when on that logic, Dougals, is always like, well, blockchain's not anything special. It's an self spreadsheet ledger. Like, that's all it is. And then it happens to be public. So I don't know. I would say if you're interested, we're going to post a link out, read it. And it's just the most interesting thing I've read in like 3 months. And it's literally a 5-minute read. It is fascinating. So yeah, we're not experts, but if that's true, I'm a lot less bullish on Bitcoin. And this actually, I don't know, if you know about Solana or Ethereum or all these other ones that have nonprofit foundations that basically run and steer the direction of the coin or the currency. That makes so much more sense because they have organized almost businesses set up to navigate the future with these currencies. And Bitcoin, I think, rebels against that. Like, that wasn't in the white paper, right? Yeah. And it doesn't feel decentralized. But if you are leaning on effectively volunteers to run the thing and maintain the thing, you'd be way better off having a nonprofit foundation to do it, in my opinion.
That makes more sense to me too. All right, I'm going to transition into the fishbowl. I'm going to summarize what I'm about to talk about, which is a Twitter thread. I'm going to summarize this Twitter thread and actually tie it back to the Bitcoin piece in maybe too loose of a way, but by saying that one of the things that's scary to me in financial markets is when you find these pockets of large amounts of capital that are pretty flimsy. And there are hidden areas, like hidden to the mass market, areas of capital, pools of capital that are riding on potentially a house of cards. I'm not saying this is definitively when I'm going to talk about a house of cards, but like what scares me is when I come across these things. So $500 billion in Bitcoin, 5 underpaid people who are basically volunteers out of passion holding up $500 billion. This one is about A16Z. All of what we're about to talk about here are this Twitter thread. Haven't done a lot of the other research. It's not I don't know. I have neutral feelings about A16Z, probably. But this is about A16Z, and I think it's interesting. So Tyler Tringas, who's the founder of a Calm Company Fund, they invest in early stage profitable businesses. This is like all up Skippy's alley. That's not what Skippy does, but I'm just saying it's like they look for businesses that are calm, they call it, right? And so you're small, You're early, but you're profitable.
Boring, profitable. That is exactly up my alley. That's
There you go.
where
There
I
you go.
live.
I do wonder how long they sat in a room trying to come up with the name, because all they could think of was boring. And they're like, we need something that doesn't say boring. That's already taken by Elon Musk, first of all. Second of all, anyway, so they came up with Calm. So that's Tyler. Has this Twitter thread about A16Z, and here are some of the highlights, and then we'll get into it. So one is A16Z has raised somewhere in the $25 to $30 billion range over the last decade. The vast majority of that has come in the last 3 years. And what Tyler's saying is that a lot of this capital came from this context of we're in a zero interest rate environment. And so there are people, limited partners, who are the people that invest in funds like this. They're limited partners that are looking for any return, right? And since they're looking for any return, A16Z was able to amass a large amount of assets, right? That's effectively cheap capital for them. And then they use that to make huge bets on crypto and late stage unicorns for the most part. A unicorn is a company that is valued at over $1 billion in the private market. And there have been a lot of them over the last few years, right? $1 billion isn't even became not even a special thing, right? Over the last few years. To give you a sense of scale, so remember I said about $25 to $30 billion raised. I got that just by looking at this chart. 7 billion of that was raised for crypto. I don't know what it was invested in, but it was raised for crypto. Okay, so that's the context. And the big question is, so how's this going to end? And I'm going to read one of Tyler's tweets here. It says, if there's one thing I've learned from a year of speaking to lots and lots of institutional LPs, it's that I have no idea how they'll perceive this or anything else, really. Not a group of people that I found a predictive mental model for. So what this tells me is that the folks that are engaged and invested in this fund, what the heck they're going to do based on all these facts, who knows? And what's going to happen to this capital, where we have $7 billion of it, not necessarily in Bitcoin, but are in crypto. That was in crypto. The crypto bubble predominantly was over like the last 1.5 to 2 years. So you're betting a lot of that, right, was invested during that time period. We don't know where that's going to go, but that's when it was invested. It's a big question mark. And so this brings to me, it's another hidden pool of burning capital.
Yeah. So a couple things. Let's assume that you're right, that Tyler shares my mindset with a lot of things about conservative, profitable, safe investments. That means that the A16Z business model and other venture capital ones is not a place where he's naturally inclined to play because his brain doesn't work that way. So that's an assumption, but just assume that. If we assume that, he's more likely to be a naysayer than others, than even folks like Bill Gurley, right? Who is conservative, but lives in VC and is experienced in VC. So I don't know if this hypothesis is tilted or fair to A16Z, but I think there's takeaways here that are relevant to all investing. And I think he's just doing a really good job highlighting what that means for these VCs. So what happened from 2008 to, we'll call it 2020, is everything made money. It was really easy to have a company become, and that's the wrong term. It was easier than average to have a company turn into a unicorn. It was easier than average to make money with early stage venture bets. And that meant that A16Z and other VCs like them had really impressive track records, right? They had really impressive track records with relatively small amounts of capital. Like if you look at this chart, in 2015, they raised maybe $500 million. In 2016, they might have raised $2 billion. In 2017, they raised, again, maybe $500 million, like nothing. And then in 2022, they raised almost $15 billion. So the capital that floods to them comes to them because of an impressive track record. And that impressive track record is due a lot to luck, a lot to skill, and a lot to other factors, right?
And brand name.
And
like
brand name,
name of the humans. I mean, not necessarily even of the firm, because you have Mark Andreessen, who started Netscape like 30 years ago.
Yeah.
Right. As an example. Yep.
These people are super talented and their track record shows it. So, but I just think of that as like your retail investor in 2020 or 2021 being like, have you seen what's happened in the stock market for the past 12 years? This is the time to throw my money at it. And like, did you see what happened to GameStop? Like, this is my chance to get rich. So money always floods in at the top of a bubble. And I think what he's effectively pointing out in the simplest sense is just the money seems to have flooded into VC at the top of the bubble as well. And then here's where I think this gets really interesting. We'd all agree that in VC, that outcomes are more asymmetric than average, than large company investing of public companies, right? So that means the returns on the positive side can be up 100 times, up 1,000 times, just absolutely massive. But the returns on the negative side are also going to be a lot more volatile. So if you just believe those two things, that humans are natural to throw money at a bubble and at the late stage of the bubble, and then VC returns are bound to be more volatile, this could create a huge challenge.
Huge.
For the VC space.
Agreed with all that. And another part of the quote unquote hidden pools that I'm talking about are what's under A16Z. Because it's the ramifications, and we're using A16Z here as an example, right? But it's the ramifications of some of these things falling that are sometimes like a question mark. Like, what's under the $500 billion in Bitcoin, right? Mm-hmm. What's under A16Z? Do you have teachers' pensions? Because a lot of who has started like really throwing money into a lot of these VCs are like in the last 5 or so years. They're both typical investors, I'll call it, but also like really large pension funds, right? For teachers and firefighters and states, right? And all state employees and all that kind of stuff. And so I don't know. I don't know who the limited partners are in A16Z, but that's the kind of thing I start to think about is when these things start to unwind, it's like Bill Hwang, right? A couple of years ago that we were talking about. It can happen quickly and you just don't know what the ramifications are. So it's an interesting take. I don't know when you dig into this, all of what it looks like. I think it's just an interesting take by Tyler. And so appreciate you putting it on the Twitter.
It's good stuff. The housing markets are in trouble, Dougals.
Yes.
And basically that's interest rate driven, but it's also driven by increasing home prices. So again, you talk about this everything bubble. Home prices went way up. That was basically funded by interest rates being really, really low. Now interest rates are back closer to historical norms, and in a few spots, home prices have pulled back, but they're not affordable. You can look at metrics like taking the existing home price divided by the average weekly earnings, and it's effectively at like a 50-year high. It's come down a little bit in the past few months, but it's not affordable. What I learned this week, which is so fascinating, the Wall Street Journal had a great article on Airbnb. There's an Airbnb bubble now, Dougals.
Say more about that. I didn't read about it.
So there was it was lucrative, right? To buy a mountain property or a mansion in Montana or a surf cottage. And especially like 3 years ago, right? Low interest rates, and the dynamics of that investment completely changed for a short-term rental. So I'd be shocked if almost everyone listening to the call hasn't listened to some friend or acquaintance in the past 5 years talk about how they own these rental properties. But what they found out, this magic hack, was that if they stop doing long-term rentals and start doing short-term rentals, they juice their returns. And I know people that actually completely changed their business model from the more predictable, I'm going to be able to cover the mortgage long-term rental, to the I'm doing all my properties short-term rental, because all I have to do is be occupied like 17 days a month and I make better returns than a long-term rental. And I know people that, like I said, completely divested their multi-million-dollar portfolio with long-term rentals, switched to short-term rentals. Well, it turns out this is just like businesses. That when there's great returns, when there's great profit margins, there's more competition.
I love that. I love that. It turns out this is, oh God, that's what it is.
So what Airbnb has right now, and it'll take me a second to pull up the stats, but they have too many of these listings. And this has become like, it was really pitched as this no-brainer. So not only is it real estate, which everyone's like, oh, real estate's like the best investment around. Like I could sleep all at night if I own real estate. But then it was like real estate that makes better returns. And it hasn't popped yet, but man, I don't know. I think it's headed that direction where there's just going to be way too many short-term rentals available. And then the downward spiral is no fun. If people don't rent your property and you're on the hook for that mortgage, are you going to switch back to a long-term rental? In a lot of cases, you're not, because you bought this vacation property where people would struggle to afford to live there as their permanent resident. It's fascinating stuff.
And yeah, agreed. And scary, man. It's just like another example. Everything, there's everywhere we look. What was that song from back in the 80s? It's like I always feel like somebody's watching me, right? You know that song I'm talking about? I feel like it's like that, but every time I open up the Wall Street Journal, like another corner of the market, and when I say market, I mean like economy, the whole thing is like looking like no bueno. I hope it's not terrible, but just like another no bueno thing. I was reading this piece about how millennial debt is now like real bad. And I just go, whew. The other thing it makes me think about is arbitrage opportunities. I'll call them artificial arbitrage opportunities, right? And how people need to recognize when something is recognized and then admit to themselves when something is an artificial arbitrage opportunity. And if you want to take advantage of it, treat it as such. Because a lot of times, let me actually back up. Here's what I mean by that. So arbitrage is when you have the difference between two prices. And the two prices should not actually be different because potentially they are the same asset, let's call it. And so the arbitrage is effectively, quote unquote, free money that exists between the two. When you take that outside of markets, investing, et cetera, what I mean by arbitrage opportunity is an artificial gap in the market where once someone realizes that that gap is there, the gap will disappear. And these things happen sometimes. It happens at work, right? When you're like, the company should operate this way. Like this thing should exist. So, but I'm going to insert myself to like fill the gap. And then don't get upset when the company just realizes that there was the gap and they just fix it. And then you no longer are able to do that thing. Like there are these artificial arbitrage opportunities. And this feels like it was one of them. This being the whole 0% interest rate thing, but in a microcosm, this whole thing. And people get stuck in this. And then if you didn't realize that that's what it was and get in, get out, ouchies.
Well, so now we're talking arbitrage opportunities. This is right in my wheelhouse. Oh, you'll bet I'm going to take some arbitrage here. One, I'm going to have some really cheap vacations when this thing crashes, man. And the surf condo that used to cost $500 a night, when it costs $100 a night, I'm going to be there. I can guarantee it. To put a bow on this, Airbnb added almost 1 million global listings in 2022, which is a 16% increase. They've been doing that for years. I mean, and I put it in context this way, like, do you think 16% capacity in hotel rooms was built last year? I would hope not. You're coming out of a pandemic still. Like, so yeah, I expect this bubble to pop. And I'm going to have my popcorn ready. I can't wait.
What is the definition of a bubble? There's the fishbowl transition. What's the definition of a bubble? Cliff Asness, who runs AQR Capital, was interviewed by Bloomberg. And there were a few points in the interview that I thought were particularly interesting. I want to highlight them, see if you think they're interesting too. One, so much as we were talking about Einhorn before and the blowout 2022 performance over there, AQR also had really great performance in 2022. In fact, it was a record year for about a dozen of AQR's funds, one of which is the Absolute Return Fund, which is the oldest running, I'll call it primary fund they had, which had a 43.5% net of fees return last year. Boom, boom, shakalaka. The question that was asked was, do you feel vindicated? And Cliff was like, kinda. Right, that was the answer. It was like a little bit. Said, one, we had a phenomenal year, and 2018 to 2020 were terrible
Yeah.
years. So he said, I feel partially vindicated. Maybe it'll turn to a yes in like if the next couple of years do what I think the next couple of years will do, which is that value ends up outperforming. Right. So we'll have to see on that one. So I enjoyed that. But now let's get to the bubble point. There was a question of like, are we in a bubble? And Cliff said, who the heck can define a bubble? There's so many different definitions for bubble. But then he goes on to talk about not a definition of a bubble, but where he thinks that we are, which I thought was interesting. The answer was not just yes. He said the end of 2020 felt like we were in a bubble, saying not since in like 2000, right, did it feel that wild and out of control from a valuation perspective at the end of 2020. But now he said it doesn't feel like the market's in a bubble. It feels like the market's very expensive. And the difference between those two is really important because this ends up being, we've mentioned this a couple times over the past few weeks. This is where it's like, it's a stock picker's market because the market as a whole, he's saying, is very expensive, but not fully in a bubble. Everything's not necessarily in a bubble, which makes it pretty interesting. It goes back to, was it mid 2021 where you were like, I can't find anything that is showing me, right, that something's worth investing in. So I thought that point was really interesting. I'll pause, see if you have any comments there before I go on.
I completely agree. I think you articulated that well.
Another point, which I just love because this is a part of your investing is contradictory thing. He starts talking about the 60-40 portfolio. And he says 60-40 portfolio, which is a portfolio of 60% stocks, 40% bonds, right? That's like your typical diversification play, your typical like written about diversification play. And then he pauses and goes, I don't know anyone that actually owns a 60-40 portfolio. It's like what he said. But
I do. A lot of those target date funds effectively end up as 60-40 portfolios.
Here's what I love, though. He goes, I don't know anyone that owns a 60-40 portfolio, but we are legally required to talk about 60-40 if we talk about diversification. I just loved it. I loved it. Okay. Now, the last point, this is the very end of the interview here, that I enjoyed was they asked him about AI and investing. And I thought these were a couple pretty interesting points. He said, in his belief, AI works well with big unstructured data sets, right? But when it comes to like small nuanced data sets, and specifically he was talking about the premium between cheap versus expensive stocks right now, what you're saying is like it's a smaller data set. He's like, I think actually human beings will do better then. And then the second thing, which we've mentioned sometimes, is when you have to answer the question of, should I stick with my current investment strategy when it's not doing well? So that is also a thing that in his mind, an AI like a Chat GPT will not be able to do as well as a human being. Is sticking out a thing that, this is my words, not his, sticking with a thing that does not make logical sense.
Yes. You know, the talking points on AI right now are shifting towards AI's true capability is going to be open source, specifically trained within your company to do the task that you want it to do. Have you heard those talking points?
No, it makes sense to me, but I haven't.
Okay. But the problem with that, and this is from someone who's done a lot of data science in their career, is like even to do fairly basic data science at large companies, I would typically run into sample size issues. Well, yeah. You can't do good data science. You certainly can't. You don't have enough models to train an AI in a way that you can actually trust it. Like, it's just amazing potential, but I'm not sold that the use cases are actually there just yet.
Yeah, and the way, and I don't know anything about the deep side of AI and whatnot, right? When I really getting into it, but the thing that makes sense to me, yeah, it's a version of the point that not that you were making about the point, but the actual point you were talking about there is there are things in a company that you need to be like best in class at. It's your core competency. This is our advantage. Don't give that to AI. Then there's stuff in your company that you could be like a C+ to a B-, and actually you just need it done. Yeah. Like something needs to be done directionally. AI can take care of that. There's a bunch of stuff in the middle, of course, right? But I think there are things where you're like, we just need like a directional answer to this, and we kind of need it quickly. And so we could either put a couple of human beings for 2 weeks on this to like figure out the directional answer, or we can just go 70% right is fine enough, and we can actually have it in 10 minutes. Like, I think that's where AI is
Well,
really gonna.
10 minutes once the model's deployed and trained, which could take
Yep.
a significant amount of time. Yeah, interesting stuff.
Cool. That's all I got.
All right, let's hit that jingle and jump to listener mail.
Love it. Here it goes.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Dougal Show.
So first, here a shout out to John, who sent us a Moody's Analytics breakdown on climate change for different U.S. economies. Newsflash, Dougals, I won't go into the details here. If you live in Florida or Louisiana, South Carolina, etc., you might be in for some flooding at some point in the future.
Heard it here first.
You shocked by this? Yeah. Our lack of an ocean here in Colorado made me feel better about things after working through this.
Yeah, but being where we are, it's like when you take all the things, earthquakes, tornadoes, transition from energy, right? What else was it talking about? Hurricanes, right? All that stuff. Like, cool.
We're pretty good. We lucked out in this lottery. The next piece of listener mail we got, I think, was from Adam. This is about Coinbase earnings, Dougals. And this is one of your pet topics where you get fired up. So just hold back. Okay. It's not fun to throw this much shade at Coinbase, but this balance sheet is interesting. Well, did we get a P&L and a balance sheet here? I'm just pulling it up.
We got a low column A, low column B. I'm gonna stick in because you paused. I'm gonna step in right quick. So I love this because it's like the best markup I've seen in a long, most humorous and entertaining, and with intelligence behind it, markup I've seen in a while. But one quote: "Coin earnings look like a smeared turd on a sidewalk." Continue.
All right. Well, let me ask a question first. He talks about AUM, which is assets under management, being down 71%, which obviously most digital currencies are down at least 71%. So even if you have your same customer base, your AUM goes way down.
Yep.
I don't know Coinbase's business model well, but I thought AUM didn't really matter for them because they charge fees on purchase events. It's not like then they take, like the Edward Jones model, then they take a percentage of your holdings each year. In investment management, AUM really matters. In Coinbase's business model, does AUM matter? Or is that just, he's just trying to show that means the rest of the business is hurting because there's less resources to pull from with transactional decisions?
Yeah, my interpretation was that plus just popularity, right? Like if you take it to the extreme, if AUM went to $1,
Yeah,
how are you going to tout your company?
that's fair. Okay.
That was kind of my interpretation. All up in here, though, there's some expletives. You know what I'm saying? There's some emojis that represent expletives. This is brilliant. We'll put this on the Substack on Monday because it's just like a really interesting markup that makes me not even want to check the stock price on Yahoo Finance, but I did. So I looked at this and I was like, how's Coinbase doing? Up 70% for the year. And I just went, I give up.
Okay, well, let's hit just a few high level points. So total transaction revenue full year 21 was, these are millions, so almost $7 billion. Full year 22 was 2.3 billion. That's different, Dougals.
Yeah, that's true. That's true.
That's different.
That's true. That's true.
Their interest income is way up. So this guy's making jokes about Jerome Powell helping their business model, which is interesting because they're holding a lot of cash in treasuries, basically. And that almost saved their Q4 reporting. That's funny. I was surprised. Coinbase did layoffs and their full-time headcount at the end of 21 was 3,700 people. And now they have 4,500 people. So like, it's the same with the Googles and the Metas. Like they hired so rapidly that even if they did layoffs, they still,
they're still up.
Like the headcount's way up. So just those trends alone, if you look at revenue being, less than a third of what it used to be, and your headcount going up by like 800 people, on a base of
Yeah.
roughly 4,000. Like, that's not sustainable.
This gave me one new goal in life. And that goal is, if I am ever in charge of or an executive of a publicly traded company, to never have anyone mark up my financials and use things like poop emojis, the word insane, and lols.
Where is the LOL on this? I got
It's down at the bottom. It's about the headcount piece.
It's about the head count. There is a clown emoji too, which is pretty fun.
Yes. So new goal in life. Boom. Ship it.
This
Thank
is the
you.
type of listener mail that I'm into. Douglas, the problem with that is when you're the head of a publicly traded company, if your financials are LOL worthy, they're going to get out there. It's not really something you can control. You can't just be like, I don't like this number.
Yeah, that's true. That is true. Dude, can we just leave? Can we just redact? I'm going to put 10Ks out there with full redacted financials.
There's one comment, and this is half about the markup, that says, what type of mentally ill institution is still holding assets here? The mental hospital? Like,
Man,
it's hyperbolic, but it makes you chuckle.
Yeah. There you go. Thank you. Thank you for the listener mail. All right. Is that a wrap?
That's a wrap. Hit us with a review. We haven't mentioned it in a while, but we have some really awesome premium subscribers that help keep the wheels turning behind the scenes here, help make sure we're not in the middle of an Airbnb bubble. If you want to support the show that way, we would greatly appreciate it. And you can find that at skippydougals.supercast.com. There's multiple tiers of subscriptions there. You get the podcast early, and sometimes you get some additional premium content from us. Always rate and review the show to help people find us. And we need a tiebreaker to figure out who's right on the Winnie the Pooh copyright law debate. So I do, because I think it should be the first vote that hits the inbox. Team Skippy, Team Dougals, and then it's over.
So it's like golden goal.
Yeah.
Okay.
It's cool.
All right. Let's do it.
Yeah.
Thank you, everybody.
Thanks for hanging out with us today, guys.